Okay, so no Ellie yet, right? LEC? No Casey yet? No Griffin yet? No Jeanette yet? No Nathan yet? Is that right? No Justin? No Lester?
Are you talking about me?
No, LEC. Eliana.
Okay.
Yeah, sorry. So there's Casey. And then no Michaela Z, right? Perfect. All righty, happy Tuesday to you. As I said yesterday, in areas you should see the two assignments that we had last week, the role of government case study, and then the redistribution programs, tax safety net programs assignment in areas. Some of you turned that in last night. That'll be updated by this afternoon. So if you turned that in yesterday after about 3:35, 3:36, I think is when I did the update. You'll see your grade updated after 3:15 today. So check and make sure that that's right. As I said yesterday, what we're going to do is get you ready for your stock market game project, as well as get you ready to take the Unit 3 test over the U.S. Free Enterprise System. So if you go to the week 11 module, we're going to go over sort of the basics of the stock market project and what we'll have so that you can see what's going on. So go ahead and go to week 11 in your Canvas. All right, so every semester, what I do is basically divide up the class into 3 different teams. I will give each team $100,000 of money for this project. You're not graded on whether you make a profit or not, right? There's ebb and flows, there's up and downs to the stock market, and in a short period of time, if we're in a down cycle, it's hard for us to overcome that. Especially the group last spring, right? Things started shutting down, the stock market started crashing. It did not go over well in terms of profit or losses. You just have to make a certain number of trades per week as a group. So in this class, there's 28 of you that come on a regular basis. divided into 3 teams. So there'll probably be 2 teams of 9 and 1 team of 10. And we'll walk through, it's very, very simple in terms of what you're able to do and how you're able to play. So first, this is an overview of the stock market game. So let me bring that up. So this will explain the investing portion of it.
Chapter 1. Why is investing important? In this video, we're going to learn short-term versus long-term goals, saving versus investing, emergency funds, risk, and why the stock market game is relevant to you. Saving means money not spent. Saving money means that you're putting a portion of your money from your allowance, birthday present, part-time job, or other source in a piggy bank or bank account. You may be saving your money for a short-term goal. A short-term goal is something you want to do in the near future. The near future can mean today, this week, this month, or even this year. Examples of short-term financial goals are saving money to buy a bike, a new pair of shoes, or a video game. It may also include saving money to build an emergency fund. An emergency fund comes in handy when you must pay for an unforeseen event, like a flat tire, or a future event, like a cousin's birthday. It's also useful if you're out of work and still need to pay bills, buy food, and pay for other expenses. You can use the money you saved up in your emergency fund while you're looking for a new job. Now take a minute to write down 2 short-term financial goals you may have. A long-term goal is something you want to do in the future. Long-term goals are usually several years away. Some examples of long-term financial goals are paying for college, buying a home, or even your own retirement. Take a minute to write down 2 long-term financial goals you may have. Like riding your bike to a faraway destination, saving your money can get you there, but it may take a long time. That's where investing comes in. Investing is when you buy something with the expectation that it will earn you money over time. Like how driving your car can take you a lot further than riding your bike for the same amount of time, investing is a way to earn more money in the same amount of time it would take to save it. However, investing is riskier than saving. Risk is the possibility of loss. Investing is riskier than saving because there's a possibility that your investments don't grow. However, investors willingly take on additional risk because of the potential to earn more money than just saving it in a piggy bank or bank account. There are also other perks to investing. Investors invest in companies they believe in. Whether your passion is medicine, the environment, advocating for diversity and equity, or other, you can drive innovation, growth, and change for what you're passionate about by investing your money. So, why is the stock market game relevant to you? In the stock market game, you'll learn all about investing. Our goal is to fill your brain with investing knowledge so one day, when you have enough money saved up, you can invest safely and wisely to achieve your long-term goals, whatever they may be, and make the world a better place. Exit ticket. Why is investing important?
Okay, so a couple of things. One of the important things that you'll do over a period of time is save money for retirement. So this last unit, we talked a little bit about redistribution programs and safety net programs. And one of those things that was established was Social Security. And so we talked about Social Security, and that is a government run basically retirement program for everybody that works in the United States. And upon a certain age, it started out as 65. I believe Herbert Hoover was the first one to think about this. But basically, upon age 65, what happens is the government starts paying you back for what you have put in. And so we talked about this before, right? My generation paid for my parents' generation as well as my grandparents' generation. When you start working, or if you have started working, what you have done basically is paid for your parents, right? Probably close to my age, and your grandparents' generation. And so Social Security was started in that first era of expansion. So if you remember back to the units that we talked about, let me bring that up, where we talked about the creation and expansion, this is what you have, right? So you have Social Security provides pension to retired workers. You put in so much money a month, and basically upon the age of retirement, 65, 66, 67, 68, whatever it's going to be for your generation, the government will start paying you back for what you had put in. And that is one of the retirement benefits that you'll have. But you'll also want to supplement that with your own retirement. Now, we'll go over a lot of 401 programs. So depending on whether you're private sector, public sector, a 401 program is money that you put in and basically your employer matches it. So a lot of 401ks, basically you put in $1 and a lot of private companies will match that at least 50 cents on the dollar. Some will match it 80 cents on the dollar. Some will match $1 for dollar. Just depends upon your longevity with the company and what you are putting in. But that is something that you want to look at. And the reason that investing is important is because you want something to supplement Social Security. So Social Security is not going to replace your income that you made through all those years. It's just going to be a portion of that. And that's why you want to make sure that you have some investing. And so we'll talk about the three most common types of investments: stocks, mutual funds, and bonds. And the reason that it's important to use all three of those in this competition, but more importantly, when you are out in the workforce in your career. So this will explain here what is a stock and what is a ticker symbol. You reset this and make sure that it's up. Okay.
Chapter 3. What is a stock and ticker symbol? In this video, we're going to learn about stocks, ticker symbols, exchanges, subsidiaries, and parent companies. Owning a stock means owning shares or part of the company. If you think of a company as a pizza pie, your stock would be owning a slice of that pie. Companies issue stocks to raise money for a variety of reasons, including expanding their businesses and modernizing their operations. Investors buy stocks with the expectation that the companies they invest in will increase in value over time and earn them money. So how do stocks earn money over time? Let's backtrack first and talk about ticker symbols. A ticker symbol is a unique group of letters that identifies a company's stock on the exchange. An exchange is a marketplace to buy and sell stocks. For example, the NASDAQ and the New York Stock Exchange are two marketplaces you may have heard of. An easy way to search for a company's ticker symbol is by typing in the company's name on the financial news and information site in Yahoo Finance. You can see that Twitter's ticker is TWTR, and its stock price today is $37.12 per share. So how do stocks earn money over time? If the stock price is more than what you paid for it, your investment increases in value and is earning money. less than what you paid for it, your investment decreases in value and is losing money. However, you can't lose more money than the original price you paid for stock. When searching for companies, you're going to have to recall what we learned in the Chapter 2, What is a Company video. For example, one roadblock you may run into when searching for a company is typing in a brand instead. A brand is the name a company gives a product it makes or a service it provides. So if I were to type in Doritos, I hit a roadblock because Doritos isn't a company. It's a brand of PepsiCo. Instead, I would need to type in PepsiCo to get the ticker. When I invest in PepsiCo, I'll be investing in their brand Doritos and its other brands. We also learned that some companies are private. You may run into a roadblock when searching for a private company. A private company is a company that is privately owned by a group of people. Shares cannot be purchased. So if I were to type in Staples, I hit a roadblock because Staples is a private company. Lastly, if you can't find the ticker for a company, it may be because it's a subsidiary. A subsidiary is a company that is 50% or more owned by another company called a parent company. If I were to type in Marvel, I hit a roadblock because Marvel Studios is a subsidiary of the Walt Disney Company, the parent company. If you can't easily find a company's ticker, don't give up. This is a challenge for you to find out why. A simple Google search for company ticker symbol is sure to put you on the right track. Now let's circle back to our focus topic. We want you to answer, what is a stock and what is a ticker?
Okay, so one of the things that I recommend when doing this, as I said, there'll be 3 groups in this class, 3 teams. Each of you will have $100,000, is to do some research. And I have found that the easiest website to use is finance.yahoo.com. And it's just very simple. It sees all of the major exchanges, right? Have a ticker up here. You also have latest in business news. Tesla stock is off its high, but it's not on sale, right? Says a trader. You've got cryptocurrencies. You can see Bitcoin is down $1,800 today. There's a number of trending tickers, right? Most active during the day. You have the stocks that are gaining the most. You have stocks that are losing the most. You have mutual funds, different currencies, futures on different exchanges. There's a number of different things that's available to you. But one of the nice things is that you can look for different companies. So if you wanted to go, right, we had the Johnson & Johnson was the 3rd vaccine. So if you wanted to look up Johnson & Johnson stock and see what it has done, all you have to do is type that in there. And then, as they were mentioning, all of the information that you need is provided. So Johnson & Johnson right now is $160.70 a share. It's up 20 cents today, which is 0.12%. The stock symbol for Johnson & Johnson is J&J. It'll also provide you information. One of the most consistent indicators of how a stock is doing is its price earnings ratio. Basically, the higher this number here, the more the stock is earning compared to its price. And you want that as high as possible. You can also see the 52-week range. Johnson & Johnson has been as low as $113.86 in the last year. It's been as high as $173.65. You can see the one-day movement of the stock here, the last 5 days, the last month, the last 6 months, and year to date, right? back on January 4th, which is the first Monday, it was at 156.50. It's now at 160.71, so it's gone up $4.21 a share in the 3.5 months of this. So that's sort of the place that I go to look up the information based on a stock. All right, let's get you to the next page. Now I'll explain a little bit about what is a company.
Chapter 2. What is a company? In this video, we're going to learn what's a company, product, brand, public company, and private company. Do you know the name of this soda? Do you know who makes it? Now, how about this one? Who makes this one? Sodas, Pepsi and Pepsi Wild Cherry, are two products made by the same company, PepsiCo. A company is a business formed to manufacture or supply products or services for profit. A product is an item sold by a company. So regular Pepsi and Pepsi Wild Cherry are both products of the company PepsiCo. Now, do you recognize these? What do they all have in common? They are three brands from the same company, again, PepsiCo. A brand is the name a company gives a product it makes or a service it provides. In this instance, Pepsi Soda, Doritos Corn Chips, and Cheetos Cheese Snacks are all brands of the same company, PepsiCo. Now, there are two different types of companies, private and public companies. A public company is a company whose shares can be purchased, meaning an investor can purchase a piece of the company. A private company is a company that's privately owned by a group of people. Shares cannot be purchased. PepsiCo is a public company. This means you can own a part of it by buying its stock. As a part owner, you make money and the company makes money. Now think about the clothes you wear, the games you play, and the food you like. Do you have a favorite pair of Levi's jeans? Do you play Minecraft? Or do you like Big Macs? These products are made by public companies that you can own a part of, but more on that in the next video. Now we'd like you to answer, what's the difference between a product, a brand, and a company?
Right. So what I want you to think about is companies that you enjoy and that you believe in, because that will be the first thing that you do within the stock market game that we set you up for. So you will have the ability to buy stocks, you will have the ability to buy mutual funds, and you'll have the ability to buy bonds. There are government bonds and corporate bonds. And so we will explain all three of those here, and then have you fill in some information on the companies that you like. So this explains when you buy a stock, what happens and why it's advantageous to you. And as I said, this is just a supplement to Social Security, something that you will want to make sure that you have.
Learning about investing is a lot like learning to ride a bike. At first, it may look intimidating or complicated. Dangers seem to be everywhere. That's why it's important to learn the basics and ways you can help minimize risk and protect yourself. After a good amount of practice and learning, you can take the training wheels off and really start riding. Along the way, the roads may change. There'll be good days and bad days. And while learning to ride doesn't guarantee you a spot in the Tour de France, riding a bike could get you where you want to go a little faster. Let's start with the basics and look at one of the most common investments, stocks. A stock represents partial ownership of a company. When you purchase a stock, you're buying a piece or a share of a company. By owning a share, you own a small fraction of the company's assets and have a claim on its future earnings. There are two ways you can make money by investing in stock. The first is through stock appreciation, when a stock you own goes up in value. If an investor bought the stock at one price and the price went up, the investor could then make money by selling the stock to another investor at the higher price. The second way is through a dividend. This is a periodic payment issued by some stocks. A dividend is a way for a company to give a portion of its earnings to shareholders. Here's an example of how stocks work. Suppose there's a company called Full Flag Cycling. This company makes bikes, really good bikes. The bikes are so good, in fact, the company wants to expand, so it can sell more bikes to people all around the world. To do this, the company needs to raise money, also known as capital. There are a few ways this company could do this. It could take out a loan, but that would mean taking on a significant amount of debt. Or it could issue shares of stock. By issuing shares called going public, the company can raise money without going into debt. Instead, it sells shares of ownership and a claim on future earnings to investors. So let's meet a typical investor. Our investor is someone who has a little extra cash. He's looking for an investment that has the potential to offer better returns than a savings account, and he is willing to accept the higher risks of investing in this stock. He thinks Full Flag Cycling is a promising company that's likely to grow. Because of this, he thinks buying a share would be a good investment. So how much does a share cost? Suppose the company decides to raise $1 million, and it decides to issue 1,000 shares of stock. Because each share represents a fraction of the company's worth, and there are 1,000 shares, each share represents 1/1000th of Full Flag Cycling. Because the company is raising $1 million at the initial public offering, or IPO, each share would be initially valued at $1,000. Let's suppose the price doesn't change after the IPO, so our investor purchases a single share on the open market through his online stockbroker for $1,000. Now, let's see what could happen to his investment. If the company does well and profits increase, the value of the company is likely to go up. As a result, the
I
stock
was thinking the same thing.
assuming the price of the stock goes up,
Hey, look, you want another?
by selling his shares to another investor in the stock market. However, if the company's ventures don't go as planned, its value could decrease, and so could the stock price. If this happens, our investor could lose money if he decides to sell at the current price. When it comes to investing in the stock market, the basic goal is to buy when prices are low and sell when prices are high. But stocks in the stock market don't always go up. Sometimes they stay the same, and sometimes they go down. And sometimes prices change quickly. Because of this, stocks are considered riskier than other historically safer investments such as bonds or CDs. However, investors keep coming back to the stock market. Why? Because with this increased risk comes the potential for greater returns. Savvy investors take precautions to try to minimize risk, like creating an investing plan, adding diversity to their portfolios by investing in a variety of companies, putting money in other investments besides stocks, and learning trading strategies for up, down, and sideways markets.
Okay, so one of the first things that I'm going to have you do in your group is basically complete a stock trade. And we will do that together, each of your groups. And I want you to think about a type of company that you like, that you believe in their stock, and I'll tell you what you need to do with that information. There will be two other investment types that we have. Now, as I said, stocks are one of the riskiest investments because the stock market goes up and down. As we said, right, if we look at the stock tickers today, where things are at, you can see that the Dow Jones Industrial Average is down 41 points already. The S&P 500 is down 1.64. NASDAQ is down 47.28. So this varies from day to day, right? Varies day to day. So that is why it's one of the riskier investments that you have. But the younger you are, the more years that you have to sort of weather the ups and downs and do extremely well. The last two types of trading investments that we'll do three types of investing: stocks, mutual funds, and bonds. This is an explanation of what a mutual fund is. And then we'll do a bond.
A mutual fund is a collective investment that pulls together the money of a large number of investors to purchase a variety of securities, like stocks or bonds. When you purchase a share in a mutual fund, you have a small stake of all investments included in that fund. Think of a mutual fund like a basket of investments. When you purchase a share in a mutual fund, you are buying one share of this basket, and therefore have a stake in one small fraction of all the investments in that fund. Mutual funds can potentially benefit investors in several ways. They are a way to make a diversified investment. Most are managed by financial professionals, and because of the wide variety of mutual funds, they allow investors to participate in a wide variety of investment types. Let's walk through an example of how a mutual fund works. Suppose there's an investor who wants to invest some of his retirement portfolio in the stock market, but he doesn't have time to analyze individual stocks and create a diversified stock portfolio. Instead, he decides that he'd rather purchase a mutual fund. This way, the investor can purchase a single investment, which will be similar to purchasing an entire portfolio of stocks. But which mutual fund is right for him? To find the right one, he uses online tools such as mutual fund searches and ratings given by independent third-party organizations to find a mutual fund that meets his investing goals. Once he finds a fund that looks like a good fit, he reviews the fund's prospectus, which is the official summary and explanation of how the fund operates. The prospectus provides a variety of information about the fund, including its fees and charges, minimum investment amounts, performance history, risks, and other useful information. After researching the fund and its prospectus, our investor decides that this fund looks like a good investment. So he buys the minimum required investment amount and purchases shares of the mutual fund. By owning shares, the investor now participates in the gains and losses of all companies held in the fund. A benefit of this is diversification, which is when an investment or portfolio is spread across several different investments. Doing this can help lower risk. For example, if one company that the fund invests in has a rough year, the impact on the fund's total assets can be small because that struggling company is only one fraction of the fund's total assets. Like most other mutual funds, the fund the investor chose is actively managed, meaning it is run by a fund manager or managers who buy and sell the fund's assets. Fund managers aim to provide the biggest returns they can for investors by using financial analysis and professional expertise. While a talented manager could earn good returns for the investor's fund, there is no guarantee of success. If a manager makes choices that don't pay off, our investor won't earn the returns he was hoping for. However, even if the fund doesn't perform well, the manager still collects a fee, which is paid from fund assets, meaning even lower returns. Management fees aren't the only costs our investor has to pay either. Besides transaction fees, the fund may have a sales load, which is a charge to either buy or sell shares. Some funds also charge an additional load if shares are sold within a specific time frame. Now that the investor has bought into a fund, how might he make money from it? One way is through appreciation, which is when the fund's shares go up in value. Typically, when the fund's assets rise in value, the fund's shares do the same. Unlike a stock, the value of the fund's shares does not change throughout the trading day. Instead, the fund's value is calculated and updated when the market closes. Another way an investor might make money from a mutual fund is from a dividend payment, which is when a mutual fund pays out a portion of its earnings to shareholders. However, when the fund's assets fall in value, the fund's shares do the same, which is a risk of owning a mutual fund. One benefit to mutual funds is the variety of mutual funds available. Our investor chose a mutual fund that invested in stocks. However, there's a mutual fund for almost every type of investment. For example, equity funds buy stocks, fixed income funds buy bonds, and balanced funds buy both. Some mutual funds may invest in a whole index, while some others focus on stocks of a certain country or market sector. Certain funds have different objectives as well. Some may look for riskier stocks in growing industries, while others will invest in more stable companies. There's a lot to learn about mutual funds and other investment options. And we've got the
So mutual fund really is very similar to stocks in the fact that a mutual fund buys a combination, generally of stocks, sometimes bonds, to help people basically who want to invest in a diversified manner, meaning spread out across multiple sectors, across multiple amounts. And basically what you're doing is you're paying a company to basically diversify your portfolio. And your portfolio is all of your investment holdings. So it'd be your Social Security, your stocks, your bonds, your 401k, 401b, whatever your program might be there. So mutual fund is basically a way for you to have diversification, but generally you're charged a fee to have somebody do that for you. And for the most part, there are three types of mutual funds. There's ones that are very, very aggressive, ones that are very, very conservative, and some that are moderate in terms of risk. The last type of investment that we will do will be what's called a bond. There are corporate bonds, which are private sector. We talked about that last unit. And there are government bonds, which are public sector. And we also talked about that last unit. So this is what a bond is. And then we'll have you finish up with your stock research and be done.
Bonds are a common investment. However, to many investors, they remain a mystery. So let's explore what a bond is and how it might benefit your investment portfolio. A bond is simply a loan given to a company or government by an investor. By issuing a bond, a company or government borrows money from investors, who in return are paid interest on the money they've loaned. Companies and governments issue bonds frequently to fund new projects or ongoing expenses. Some investors use bonds in hopes of preserving the money they have, while also generating additional income. Bonds are often viewed as a less risky alternative to stocks and are sometimes used to diversify a portfolio. Consider this example. The city of Fairview wants to build a new baseball stadium, so it decides to issue bonds to raise money. Each bond is a loan for $1,000, which Fairview promises to pay back in 10 years. To make this loan more attractive to investors, Fairview agrees to pay an annual interest rate of 5%, which in the bond world is also known as a coupon rate. An investor buys the bond at face value for $1,000. Now, let's fast forward. Each year, the city of Fairview pays the investor $50. These regular interest rates continue for the length of the bond, which is 10 years. Once the bond reaches maturity, the investor redeems his bond, and Fairview returns his $1,000 principal investment. This bond was a good deal for both the city and our investor. Fairview got the money it needed to build the stadium. The investor received regular interest payments and the return of the original investment. Because a bond offers regularly scheduled payments and the return of invested principal, bonds are often viewed as a more predictable and stable form of investing. Compare regular payments of a bond to the experience of owning a stock. With stocks, profits and losses are driven by market forces and are generally less predictable. Of course, like any investment, bonds are not without risk. One risk that bond investors face is the possibility that the issuer defaults on paying back the principal. This is what is known as default risk. Typically, bonds with higher default risk also come with higher coupon rates. The amount of risk depends mostly on the financial stability of the issuer. For example, most governments are generally considered stable issuers and issue bonds with a relatively low coupon rate. Corporate bonds typically represent a greater risk of default, as companies can and do go bankrupt. That's why corporate bonds often offer a higher coupon rate. Several credit rating agencies assign rankings to different bonds. This can help bond investors to gauge the financial strength of the bond issuer. These ratings agencies often use different criteria for measuring risk. So it's a good idea to compare ratings when considering a particular bond. And keep in mind, rating agencies aren't always accurate. So be sure to research a bond and its risks thoroughly before investing. Another risk to consider is interest rate risk. This is the risk that interest rates will go up, and any bonds you own will be worth less if sold before the maturity date. After all, when interest rates rise, more investors allocate their money into the new, higher interest rate bonds. If you wanted to unload a low interest rate bond to take advantage of these new rates, you would have to sell your bond at a discount to make it a worthwhile purchase for another investor. Capital preservation and income generation are just two ways bonds might be part of a diversified portfolio. Many investors use a mix of stocks and bonds to pursue their investment goals. And because bonds move differently from stocks, they can help increase or protect portfolio returns. Keep in mind that this discussion showed you one simplified way that investors might use bonds, and only a few of the risks to consider. Like all investments, bonds are complex and have a variety of uses and risks. Before you invest in bonds, it's important that you invest in your own financial education.
Okay. So those are the three basic things that you are going to do. And before we get started, let me show you what you'll be doing. Let's see if I've got, there we go. So as I said, there'll be 3 teams per period. So you'll be battling 2 other teams in period 1, and then the 3 teams in period 2 and period 3. And basically what you're going to do is you're going to have $100,000. And you're going to be able to buy stocks, bonds, and mutual funds. And I'll show you how to make those trades. I'll show you how to do that step by step. So it will not be very hard at all, and you'll have time in class. What you'll need to do, and you'll need to have this ready for tomorrow at the beginning of class, because you'll turn this in, is you're going to basically research. Let me bring this up. 2 different companies. So up at the top of your formative, you're going to basically research 2 companies. So you're going to input on 1 and 2 the name of the 2 companies. On 3 and 4, you're going to input their stock symbol. So for Johnson & Johnson, you could put that for number 1, and then Johnson & Johnson stock symbol. As we saw, if we go to Yahoo, move this tab so you can see it. Johnson & Johnson's stock symbol is JNJ. And then, as I said, there's going to be a closing price, right? Their closing price, the last trading day, how much per share. If you go to Johnson & Johnson, when you look at its previous close, it is right there. As I said, this finance.yahoo give you a whole bunch of information. So you can see it closed at 160.50. That's what you would put in this slot here, right? For number 3, or excuse me, number 5. Right there. And then 7 was a dividend paid last year. They'll usually tell you that. So let me show you that location as well. All right, so when you look at the second column, right, it says forward dividend and yield. Looks like it paid $4.04 a share. That is found right there. So that's what you would put on the next portion. So let me erase that so you can see it. So was a dividend paid last year? You can put yes or no, or you can just put the amount. And then the price earnings ratio. Price earnings ratio, as we said, we've looked that up before. Your price earnings ratio, you want that to be as high as possible on the company that you're looking, but it gives you that right there. Price earnings ratio is 29.17. So that is what you will have to have for tomorrow. So this, as I said, this formative is open. You're going to find 2 companies that you want to invest in. You're going to write down their stock symbol. You're going to write down their closing price from the day before. So you can use, if you do it later today, you can use today's, or you can use yesterday's. It doesn't matter. It generally won't vary very much. Was a dividend paid last year? This will give you that number there. If there was no dividend paid last year, basically what you'll have is this part will be blank. All right, and that's how you know that it wasn't paid, which is fine. right? Last year was a down year for a lot of companies and a lot of businesses. And then the price earnings ratio, as I said, is going to be there in the same spot. Now, it doesn't matter what company that you look up. So let's say we look up Apple. All right. All of these things are going to be in the same spot for you. So once you get it down for one, it's going to be very easy to find the other. So if you look at this, right, here's the previous close. Here is Apple stock symbol. The price earnings ratio you can see is higher than Johnson & Johnson. They had a very small dividend, 82 cents there, right? So stock symbol, what was the previous close? Was there a dividend paid last year? And what is the price earnings ratio? All of these things will be in the same spot for you, right? So the name is Apple, stock symbol was AAPL. Their closing price yesterday we saw is 123.39. As I said, all of these are going to be in the same spot. So you would just put that in. And then dividend paid last year, yes, but it was rather small, 82 cents. And that's right there. And then the last thing was the price earnings ratio. Price earnings ratio was a little better than Johnson & Johnson at 33.35. Right. So make sure on a sheet of paper that you have those written down, because you'll have to put those into this formative starting tomorrow. As soon as we meet for class, we'll do the review game for the free enterprise system of the U.S., our economic system, and then you'll have the rest of the period then to take the unit test. All right, questions and concerns, you can hang around. Otherwise, that's all we need to cover. We'll see you tomorrow.
Thank you. Bye.
Bye-bye, take care.
Bye.
Bye-bye.
Bye-bye.
All right, have a good one.
Sorry, I I woke up to some fraudulent stuff on my bank account and my eBay, so I had to deal with that.
That's not good.
Yeah, no, it wasn't fun.
Hackers.
Yeah. I also put in my 2 weeks at Albertsons so I can focus on school. So
Uh-oh, there you go.
I think it'll be beneficial.
Hopefully so. It's hard. It's hard doing both.
Yeah, it is. It was more than I expected. But
Yeah.
anyways, have a good day.
We'll see you later. Take it easy.